You're listening to the Ticker Podcast from IR Magazine, a roundup of this week's leading stories and industry comment from the world of investor relations. Here's your host, Jeff Cassett.
Hi, everybody. Joe Biden's nomination of Gary Gensler to head up the SEC has some people asking whether the move signals a new era in ESG disclosure. My guest today is sure of it. Joe Vicari is Broadridge Financial Solutions ESG practice lead, and he says Gensler's track record and Biden's priorities suggest ESG disclosure will at least come under greater scrutiny and potentially even regulatory mandate. On this Ticker Podcast, Joe Vicari on the big changes in store for the ESG reporting ecosystem and what companies can do to prepare. That's coming up next. But first, here's this week's IR News Update. Climate data continues to grow in importance for asset owners. But a new MSCI survey finds larger institutions are well ahead of their smaller counterparts in its use. The poll finds about half of institutions with more than $200 billion in assets regularly use climate information to manage risk and identify new investment opportunities. In contrast, institutions with under $25 billion worth of assets are about 4 times less likely to use climate data for either purpose. The number of Canadian companies publishing ESG or sustainability reports has doubled since 2016. A new study by Milani shows more than 2/3 of S&P/TSX Composite Index firms published a 2019 ESG or sustainability report. The survey finds the Global Reporting Initiative is the most popular reporting framework. Investors are feeling more confident about a recovery. The latest Bank of America Merrill Lynch Global Fund Manager survey finds the majority of bullish investors now want companies to start using cash flow to invest in the business rather than strengthen their balance sheet. This is the first time since the onset of the COVID-19 crisis that investors have not prioritized balance sheet improvements. And finally, there's been a substantial dip in global IR budgets. That's one data nugget uncovered in the latest IR Magazine Global Investor Relations Practice Report. The 2020 edition tracks all sorts of things about how IR teams operate around the world. It's just been published. And joining us is Garnet Roach to drill a bit deeper in this first installment of Garnet's IR Magazine Research Rockpile. Let's find out what she's dug up for us this month.
As companies responded to the COVID-19 pandemic, it's unsurprisingly been a year of cuts across the board. So the average budget, for example, which excludes staff costs in our research, has dropped by 16% to $329,000. Budgets have fallen at every cap size, but the biggest drop has been among mid-cap companies, where they've shrunk by almost a quarter since 2019. Despite that fall in resources, team sizes have remained broadly unchanged over the last 12 months, and there's actually been a slight increase, and globally the average is now just under 3 IROs per company. You know, here in the editorial team at IR Magazine, we obviously spend a lot of time talking to different people about these kinds of topics. So we talk with brokers, we talk with analysts, we talk with investor relations professionals. And, you know, obviously this past year, we've been talking a lot about travel. We've been talking about meetings and roadshows. And there's really a consensus that budgets, especially when it comes to these sorts of events, are quite unlikely to jump straight back to pre-pandemic levels once we can travel again. Basically, we've all learned that these things can be done virtually, and so now there isn't really the same justification to spend that sort of money to travel that there was before. And talking of meetings, I mean, these have also taken a big hit, with the global average dropping to just 123 one-on-ones last year, and that's down from 188 in 2019 and 204 5 years ago. Even as those meetings fell away, senior management involvement remained largely unchanged at around 45% globally. And that shows really that the big cuts have been made to IR-only investor meetings, which is not surprising, again. Management no doubt wanted to be on as many calls and videos with investors as possible as the pandemic continued its hold on companies.
The full report is available to IR Magazine Advanced subscribers. Less advanced listeners can download a free sample at irmagazine.com.
So it's a consulting service. Yeah. So we help corporate issuers with understanding and what an ESG program is. We do benchmarking for them against peers.
So, you've got all sorts of SASB-friendly disclosure programs set up, but you still get lousy ESG ratings. Do you wonder if investors really care that employees get access to a recycling bin? I mean, if nobody is making you do ESG disclosure yet, why start now? Broadridge Financial Solutions has a brand new ESG advisory service meant to answer questions just like those. Joseph Vicari is the man to see about it, and we'll jump in from there.
Success. We help them with the governance aspects, ensuring that they understand that shareholders are looking for oversight of ESG. So we encourage them to have a board committee, have ESG in their charter as an oversight, and that they set up a group within the organization to report into that board committee on some cadence. We actually help them write a ESG sustainability report. We have designers to help them if they want our design services to actually design that report. We give them guidance on what data should be in there, the frequency of the update, how to present it in a way that the rating agencies are looking for it, how to present it the way investors are looking to see it. So that it has the most effect.
Okay. I want to follow up a bit on your work with ESG rating agencies. In our last podcast, I spoke with Patrick Mitchell. He's also a consultant. He's in the UK. And he basically said rating agencies were just so confusing, they were putting themselves out of business. He pointed to Tesla. Great, according to one rating agency, lousy for another. So in fact, he suggested that companies shouldn't even design an ESG strategy with rating agencies really in mind. Maybe you have a different opinion. I'm curious.
Well, you can't ignore them. So ISS and Sustainalytics that feeds into Glass Lewis are feeding into the vote agents for proxy. And they're proxy, those responsible for it are looking at ESG. They're looking at that governance piece that I mentioned to make sure that there's that oversight at the board level. But you're exactly right. Confusing, irregular. They seem to be at times reviewing different companies, and yet they're the same company because it's the Wild West right now, right? There's no regulatory requirements. There's no standardization. There's no governing body right now. Some are trying to take that lead. So SASB is a good example of that, and they're joint forces with others in trying to create that standard. But it's not sanctioned by a real authority, and so companies may follow it, may not follow it. I think you see large asset managers like BlackRock trying to push these standards. Why are they doing that? Because of exactly what you said. They want the data to be normalized and usable in a manner in which it feeds into their operations, their modeling, their portfolio construction, right? But until there's more standardization and there's more of a, whether it comes with regulatory changes or not, if there was an entity that came up with true standards that was accepted across the board, I think you're going to find those issues that will continue.
So until then, until that golden moment when things get straightened out, standardized, and I want to get to the Biden administration and their plans. But now you've got companies, maybe like Tesla, who do think they're progressive, who they've got all sorts of ESG ducks in a row, and they still get lousy or maybe inconsistent ESG ratings. What do they do? Any thoughts on that?
Sure. There could be any number of reasons for companies not getting their credit or their recognition for their ESG efforts. They may feel like they're doing great things, but really it's being overlooked. Often we see that companies, they do have good programs in place, but maybe they haven't instituted a governance structure around it. Maybe they haven't identified a board committee to oversee it. Maybe there's no metrics that they've designed to monitor their progress over time. Perhaps there weren't goals set. Simply adding that committee very frequently, it's either non-gov or the audit, that oversight responsibility. Companies see a significant jump in their ESG scores because that's what investors are looking for. Those are their representatives, and they want to make sure that there's that level of oversight by the board. Another reason very often is that companies, they make qualified statements and they think that that's an ESG program and that they've checked the box. They put out that, we believe in a diversified organization. We believe in pay equality. We protect the environment in our operations. Well, that's all great, but prove it to me. Show me how you're doing that. Show me what your progress has been over time. Because it's not enough to say good things. You have to do good things. And so that's what these rating agencies are looking for. That's what investors are looking for. And quite frankly, that's what the company should be looking for their own benefit. ESG, people have various views and predefined perhaps biases around it. But really, ESG is all about mitigating risks and identifying opportunities. And you do that for sustainable financial performance. And isn't that what it's all about? Isn't that what investors are looking for? Isn't that what companies are looking for over time? Isn't that why they exist?
This whole ESG thing isn't going to blow over soon, you figure?
No, I think that there's a number of reasons. That we saw that with the pandemic, that there was a view that this would go away. The anticipation was that was going to be the death knell for ESG, and it was the exact opposite, right? We saw a huge increase in attention around that stepchild S, that social aspect. There was so much focus on the environment, governance focus was for many years. But the S was that stepchild, and it rose to the forefront. Why? Because it was all about supply chain maintenance, managing the supply chain. It was all about the care and feeding and safety of employees and workers. It was all about understanding how the S affected your business and how it could be shattered by an outside event. And were companies ready? And that's what investors were looking for. And we found that those that had programs in place, that had identified risks and oversights, they performed better. So while we had a bear market in around March of 2020, and stock market did take a big hit, those that had programs didn't take such a bad hit as others.
Yeah. The pandemic sort of accelerated things for sure. But, and this has come up before in other conversations. I sometimes get the impression that boards and even IR people, and you meet them all the time, but maybe they're not really up on the curve on this. They're still at the point where they're saying, no, we don't get any questions on, quarterly calls about analysts asking ESG questions. And yet on the other side, you have news reports that say it's all ESG. There's nothing about ESG. ESG is being integrated into the investment thesis, and so on and so forth.
So I agree with you. That's exactly what we're encountering, that companies are turning to us and saying, well, what should I be interested in this? I'm not getting any questions or very many questions. It's not coming up, as you said, on analyst calls. Why should I care? And, quite frankly, a part of that goes back to the fact that there's no standard regulatory requirement around reporting, and that it's taken time for asset managers and others to work their way down the hierarchy of companies, right? They started with the S&P 500, and you see wide acceptance and wide disclosure at that level, and you kind of see over time I'll call it the trickle down, that more and more companies are getting that call. They're getting the phone call from their largest of investors, be it a BlackRock, a State Street, a Vanguard, a FMR, saying, well, we want to talk to you about your ESG program. And they're like, what? Why? Where have you been? And why is it coming up now? Well, it's coming up now because it takes time to move down that list, because this is a process. It's not data today. It's not something that's filed like a 10Q, where there are means of extracting this and creating databases and creating analytics around it. This is more of a process of reading, believe it or not. People still have to do that. Yes, they're using AI tools, but you still have to break down this data. And what the mid-cap and small-cap companies are finding is that suddenly, and it feels like overnight, ESG is no longer an option. It's a have-to-have. And many of them are confronted by and perplexed by certain aspects of it. Some companies may say, well, I get the G, governance, been around for a long time. I get all that, the aspects of that. The S, yeah, okay, I can understand that. My employees, the care and feeding my employees, quality, diversity, community programs. But I'm not in manufacturing. I'm in, healthcare technology. I'm in banking. Where does the E come in? I don't have huge emissions. I don't produce very much waste. Why should I care about the environmental aspects of it? I'll put in some.
Investors actually care about whether I recycle my paper or not, or what
and they don't.
No, they don't. Okay.
But let's look at a bank, because I think it's a great example. So banks typically have a low impact on the environment from their corporations, but banks affect the environment through their lending practices, through their lending portfolios, right? So and those portfolios themselves, depending upon who you're lending to, may have environmental risks for the bank, because if those risks are affecting the borrowers, ultimately they affect your portfolio. And so, that's part of our ESG practice, to help issuers get an understanding to think more broadly than their own offices, their own facilities, their own people, and think more broadly around what they're providing and who they're interacting with across their operations, across their client lists, across their supply chain. But others that come to mind are technology companies, and so I mentioned supply chain a few times, and that's where not paying attention to environmental factors of where you source your materials, where you source your technology, can come back and really affect you negatively. So, as I mentioned earlier, ESG is all about identifying and mitigating risks and identifying and leveraging opportunities. And so, that goes across your operation, across your supply chain, and across your holistically across your business.
So how does the new administration, their initiatives, especially on the environmental side, but on the S side too, going to affect things? And I don't know what you're hearing, but maybe companies would like to see have some influence on that. Do they have any, input on the decision making process?
Well, I like to, in my own mind, I say, sit on the sidelines at your own peril. Because, when change does come, you're going to find yourself a bit flat-footed and scrambling to implement and execute on an ESG program. Yeah, so what the indications that we're seeing with the new administration in Washington, with some of the nominations that have been put into place, most notably with Gary Gensler, President Biden's nominee for SEC chair. Gensler, his background, he served previously as the chair of the Commodity Future Trading Commission, as well as he was on the Maryland Financial Consumer Protection Committee. And he shows a track record of being focused on consumer and investor protections.
Right.
And a track record of believing that ESG disclosures has a place in those protections. And so, the winds of change seem to be in the air. They also created a ESG advisory committee, office at the SEC. And so you combine that with during the campaign, at the time, President Biden was articulating his beliefs around climate change and the impact of society and business on climate change. You combine that with some of these nominations and other elements that are coming out of Washington today, and the belief is that the handwriting is on the wall for new regulations. Now, companies, believe it or not, many companies are, I wouldn't say anxious for this, but are a bit happy if some regulation does come into play. Because today they don't know what to do. And, going back to our earlier conversation, right? There's no standard, there's no disclosure requirements. And they're being confronted by these rating agencies. Everybody wants information, and they want it in their way. They want to meet with IR folks and others in the company to talk about ESG matters. Some want surveys completed and filled out, which are very time-consuming, onerous, and costly. The feeling is that if there was some sort of requirement that everybody had to adhere to and comply with on a regular cadence, that it would actually simplify things and that it would put everybody on the same level playing field. Your example of Tesla is a good example of that, where they get a good rating with one rating agency and a bad one with another. And quite frankly, I think that the large asset managers would embrace this also, because they're looking for normalized data, if you will, data that can go into databases, data that can go into models and algorithms for their portfolio construction and asset allocation. So everybody, I think, there's this love-hate component to regulatory change.
What's the time frame we're looking at? Usually they kind of put out a request for comment or something.
Yeah,
could be years from now.
It could be years from now. 100% true. Yes.
But still, it's like we were saying, it's best to prepare, right? What are you telling companies about that?
Well, we're seeing that with the large asset managers, there's BlackRock being the most famous of them because of Larry Fink's letter going out to all the companies, all the CEOs every year, in the past 2 years, essentially indicating that ESG matters are a part of their investment decision making, that it's no longer an option, and that they are not only going to hold companies accountable, they're going to hold them accountable by through proxy voting. And so I think that ignoring ESG is no longer an option. That every company, whether you're large cap, mid cap, small cap, if you want to play in the capital market, if you need the capital markets, if you want to continue to exist in the capital markets, you can't ignore this. It's here. It appears to be here to stay. There are some of these things do fade away over time. This one appears to have some stickiness.
And that's your Ticker Podcast. My thanks to Broadridge Financial's Joe Vicari. And a quick reminder, the IR Magazine Awards US 2021 is coming up on Thursday, March 25th at 4 p.m. Eastern. It's a virtual awards ceremony. We've got a fantastic evening planned, and hey, it's free. Register now at irmagazine.com. See you there, and thanks for listening. In Montreal, I'm Jeff Cossette.
Ladies and gentlemen, make your way to the couch. The award ceremony is about to begin.